Welcome back to the deep dive. Today we're doing something a bit specific, really focusing in. We're cracking open just the prepared remarks from a recent Q3 earnings report, what the CEO and CFO plan to say. And honestly, if you take away just one thing, it's this. The message was super clear, very confident. They kept calling it an outstanding quarter. The key phrase was sustainable, profitable growth.
Thus. So our job today is to really dig into the numbers and the strategy behind that claim. We're talking originations, the balance sheet, this whole flywheel idea.
That's exactly right. We're going to synthesize the key metrics and maybe more importantly, the strategic drivers they laid out. And yeah, we're deliberately skipping the Q&A part for this. Sometimes, that prepared script, it tells you a lot more about their long-term vision, their real confidence level, than the off-the-cuff answers later. So for you listening, this deep dive is about understanding, well, not just the big growth numbers, but the leverage in their model. How did they actually manage to scale up so much so fast this quarter? That's kind of the puzzle we're piecing together. Okay, let's dive in. Section 1, the big headline numbers. Let's start with just the sheer size of the growth. Originations, that's the new loan volume they just soared, 37% year over year. That came out to $2.62 billion. The CFO even rounded it up like over $2.6 billion proudly. And revenue kept pace, pretty much, up 32% to $266 million.
Yeah.
Impressive stuff.
Definitely impressive top-line numbers.
But here's where, like you said, the leverage kind of hits you. Revenue's up 32%. Okay, the pre-provision net revenue, PPNR, that jumped 58% to $104 million. That gap, revenue growth versus PPNR growth, 32% versus 58%. That seems huge. What does that really signal about their business model?
Yeah, that margin expansion is really telling. It suggests they've hit a kind of critical point with their operational scale. When your revenue grows that much faster than your core operating costs, it tells you they're getting really efficient with their sort of fixed tech base. Think about it, right? Their platform for originating and servicing loans. It's mostly digital, automated. So once that infrastructure is built out, the extra cost, the marginal cost of handling, say, the $2.6 billion of loans, it's almost nothing.
Ah, okay. So more revenue flows straight through.
Exactly. A big chunk of that new 32% revenue just drops to the bottom line, which lets the PPNR grow by that massive 58% without needing, tons more people or buildings.
And that efficiency, that leverage, it showed up directly for shareholders too, right?
Oh, absolutely. The profitability metrics just exploded, basically. Diluted earnings per share, EPS, and return on tangible common equity, ROTCE, both nearly tripled compared to last year. EPS hit $0.37 a share, and ROTCE landed at 13.2%.
13.2%, wow.
And what's really key there is that 13.2% ROTCE number was actually above the high end of their own guidance, which, signals management is feeling pretty good, confident about how fast their earnings power is accelerating. It really shows the strength of this digital marketplace bank model when it's running at full steam.
Okay, so the profitability is clearly there. But, rapid growth, 37% jump in originations.
Yeah.
That's really aggressive. It always raises that question for investors, doesn't it?
Yeah.
How good is the actual credit quality? Are they lowering standards just to hit those big numbers?
That's always the potential friction point, you're right. But based on what they said, their prepared remarks, the answer seems to be a pretty confident no. The CEO talked about their success coming from a mix of things. Really competitive loan rates, their sophisticated credit models, data-driven stuff, and what they kept calling a fast, frictionless process.
And they had that amazing stat to back it up, too. So that when their loan offers show up side by side with competitors on a major comparison to website, they actually closed 50% more customers on average. That's huge in a competitive online space.
Yeah, 50% is staggering. It tells you a couple of things, I think. First, yeah, their pricing must be sharp. Probably reflects, their efficient cost of capital. But second, and this is just as important, it says their user experience, their UI UX must be really good. In the digital world, if applying is fast, easy, transparent, that experience itself is a massive competitive advantage. It turns directly into market share.
So, okay, they're winning the customer at the point of sale. But are they winning on quality too? Are these good loans?
They claim they are, yes. They specifically stress that this huge growth is balanced. Balanced with, and this was the phrase, roughly 40% outperformance on credit versus their competitors.
40% better credit performance.
Yeah. It comes down to their proprietary credit models, they say. Allows them to spot and approve good borrowers that maybe others would miss or decline. And you see that discipline reflected in the numbers. The net charge-off ratio, NCO, actually improved a little bit again this quarter, down to 2.9%.
Okay, so charge-offs are low and stable.
Right. And they also made a point to say their lifetime loss expectations are holding steady or even improving across all the different batches or vintages of loans they've issued. So the takeaway for an investor seems to be, yeah, they're growing incredibly fast, but they're also maintaining underwriting quality that's significantly better than the competition. That's the key combo.
Okay, we've got the scalable model, good credit quality. Now let's look at the financial structure itself. You mentioned the bank structure. Total assets grew to $11.1 billion, up 3% from Q2. But how does being a bank help them create what they call that durable, resilient revenue stream that non-banks can't match?
Yeah, being a regulated bank gives them real structural edges, especially around funding costs, how much they pay for the money they lend out, and also revenue stability. We should probably break down their revenue. There were two main pieces, and both hit records this quarter. First, there's net interest income, or NII. That hit $158 million, an all-time high.
Okay, and what drove that?
Two things, mainly. One, just having a bigger portfolio of loans earning interest on their balance sheet. And two, they keep optimizing their funding costs, meaning the cost of the deposits and other money they use to make loans is going down. That focus pushed their net interest margin, their IM, up to 6.2%.
6.2% in NIM.
Pretty healthy.
Very healthy. And then the second piece is where the marketplace aspect really comes in.
Right, the non-interest income.
Exactly. Marketplace or non-interest income. That grew an incredible 75% year over year.
Yeah.
To $108 million. That growth came from, again, two main things. Just selling more loans through their platform, higher volumes, and also getting better prices for those loans when they sell them. So explain that marketplace bit for listeners. They make the loan, then sell it off.
Sort of, yeah. They originate the loan using their efficient platform. Then they sell a portion of those loans pretty quickly to big institutional partners, like investment funds. This generates fee income for them right away, and it also frees up their own capital so they can go out and originate even more loans. It keeps the machine running.
Yeah.
And that fee income, that growth, it's basically a stamp of approval, right? These big institutions only buy loans they trust are well underwritten.
And speaking of trust from institutions, they had some big news on that front this quarter, didn't they?
Huge news. They mentioned their best quarter ever for selling these things, got structured certificate, over $1 billion worth. But yeah, the real headline was that BlackRock deal, the Memorandum of Understanding, the MOU.
Right, the BlackRock MOU. What's the significance there?
Well, it's a commitment by BlackRock funds and accounts to buy up to $1 billion in loans through their marketplace by 2026. It's not just the billion-dollar number, though that's big, it's the signal it sends. BlackRock does serious homework, serious due diligence. Having them commit like this, it basically validates the company's entire underwriting model for the long haul. It makes their loans seem like a premium asset out there in the market.
So it attracts other investors too, probably.
Exactly. And they're leaning into that. They mentioned they're designing a new rated product specifically to attract insurance company capital. And apparently it's getting strong interest already. So they're deliberately trying to broaden their base of capital partners, which helps them keep that marketplace revenue growing and potentially get even better prices for the loans they sell.
Okay, so the financials are strong, the institutional demand is there. Let's pivot now to the customer side. The CEO talked a lot about this engagement flywheel, this idea that product innovation isn't just about serving customers. It's actually a strategy to lower customer acquisition costs over time and boost lifetime value.
Right. It's about making the platform stickier.
They pointed to two main products, Level Up Checking and something called Dead IQ. Let's focus on Level Up Checking. Launched this year. They said it's specifically designed for their borrowers, and the uptake sounds amazing. A 7x increase in people opening these accounts compared to their old checking product.
7 times is a huge jump.
And just to give a sense of scale on their deposit side, they mentioned Level Up Savings is nearing $3 billion in balances.
Okay, but the key question is, is this product design actually changing how borrowers behave, or are people just opening another account?
Good question. What did the data say?
The data seems to strongly back up the strategy. They said nearly 60%, almost 2/3 of these new Level Up checking accounts are being opened by people who already have loans with them.
Ah, so it's deepening the relationship with existing customers.
Precisely. By giving them a better tailored banking experience, they're drawing them in further, and this seems to be working. They reported a nearly 50% jump in how often borrowers log into the app each month.
50% more logins.
Yeah.
That sounds like a lot more engagement.
It is, and that's where the flywheel idea really kicks in. That habitual interaction is what they're aiming for.
So if the borrower is in the app all the time, checking their Level Up account, what's the payoff for the company? How does that translate financially?
Well, I see it as sort of threefold. First, the company gets richer data on customer behavior. That helps them underwrite better, manage risk better down the line. Second, the cost of funding could potentially go down. If they can fund new loans using these customer deposits from Level Up Savings, that's generally cheaper than other sources.
Okay, data and funding costs. What's the third?
The third, and maybe the most important strategically, is marketing efficiency. Like the CEO said, these investments lead to lower cost acquisition from repeat members.
Hmm.
Think about it. If a happy customer is logging into your app regularly and they see a pre-approved loan offer right there, you don't need to spend nearly as much money on external ads trying to get them to take out another loan. The app itself is doing the work.
Right, the flywheel is turning.
Exactly. It's generating repeat business more cheaply and ultimately boosting that lifetime customer value.
Okay, let's wrap this up by looking at costs and what they're projecting for the future. Section 5. They did spend more. Non-interest expense was $163 million. That's up 19% year over year. But they were pretty clear about why, weren't they?
Yeah, they explained it carefully. Said it was mostly driven by strategic marketing spend, basically investing now, scaling up, testing channels to support the really ambitious growth targets they have set for 2026, spending now to win market share later.
Okay, so it's investment spending, not just runaway costs.
Seems so. And despite those investments, the underlying business efficiency looked really strong. They mentioned their efficiency ratio was actually approaching an all-time best this quarter.
And pre-tax income.
Record high. $57 million, which, again, more than tripled compared to Q3 last year.
Tripled. That's strong follow-through.
Absolutely. And that performance gives credibility to their forward guidance for Q4, even considering that Q4 can sometimes be seasonally a bit slower. For Q4, they're expecting originations between $2.5 billion and $2.6 billion.
It's a pretty high volume.
Yeah, and crucially, that range would still be up 35% to 41% compared to Q4 last year, so they're planning to keep up that aggressive year-over-year growth pace.
And what about profitability in Q4, the PPNR and ROTCE?
The outlook there stays pretty solid, too. Q4 PPNR is guided between $90 million and $100 million, and the ROTCE is expected in the range of 10% to 11.5%.
Okay, slightly down from the record Q3, but still strong year over year.
Exactly. Remember, even that 10% to 11.5% range would still represent more than triple the ROTCE they achieved in Q4 of the previous year. So yeah, the momentum, the operating leverage, they clearly expect that to continue.
So let's bring it all together. For you, the listener, what's the core story here from these prepared remarks?
It feels like the narrative is exceptionally clear, right? This record Q3 came from getting two big things right at the same time. One, really efficient customer acquisition, winning those competitive bids like that 50% stat showed. And two, really strong demand from institutional investors in their marketplace, cemented by things like that BlackRock deal.
I agree. That's the core performance story. But there's maybe a final strategic thought to chew on. The CEO kept talking about that flywheel to increase lifetime value, created by intentional product design and an engaging mobile experience. So the question for you to consider is this. How does focusing intensely on existing borrowers, using products like Level Up Checking to make their banking life better, how do they create a path to better long-term financial health? Not just for the company, but maybe even for the customer, too.
Interesting angle. Moving beyond just loans.
Right. This deliberate link they're forging between their banking products and their lending activity. That seems like the key strategic insight here. It potentially moves them beyond just being a loan originator and turns them into more of a whole financial ecosystem for their members. And that could be a really powerful long-term advantage compared to competitors who are just focused on spending big bucks on external marketing to find the next new customer. This engagement flywheel is about building deeper, more valuable relationships.
A fascinating strategic point to end on, building an ecosystem, not just selling a product. That wraps up our deep dive into these prepared remarks. Thanks for joining us. We'll see you next time.